Hi and welcome to our webcast. Look, I like to give each of these sessions a name, so I want to call today's session The Housing Boom's Over, but Don't Lose Any Sleep. Look, clearly the market has moved to the next phase of the property cycle, so to help us get a better understanding of what's ahead for 2018, I've invited Australia's leading independent property economist to join me today, Dr. Andrew Wilson from myhousingmarket.com.au. Welcome, Andrew.
Thank you, Michael, and I think your introduction was very appropriate regarding the theme. The boom is over, but really there's nothing to get too excited about in terms of the future outlook, and I think that's what last year, and Happy New Year to you, Michael, I think that's what last year really crystallised, was that we're finally losing all that latent low interest rate energy that we've had over the past couple of years.
Well, I'm pleased we're chatting, Andrew, because over the last few years there have been two groups of people. There's been the property pessimists. They've been warning us that our obsession with buying houses is going to end in tears, and it hasn't happened. They've come every year. Also, there was another group of people, Andrew, the hot spotters, leading us down the garden path, yet each year, I know you've been presenting at my annual property market and economic updates for quite a few years, and I've been impressed, and I know the attendees have been, with the accuracy of your forecasts.
Thank you.
So it'll be great to hear what you've got to say. So maybe we can look back at last year. You started to say it. How would you characterise 2017 with regard to property?
Well, look, I think we did see, Michael, clearly the dissipating energy of our housing markets, particularly the big two, the big one, I guess, Sydney, which has been a remarkable story over the last 5 years. We've seen double-figure prices growth in that Sydney market, following sharp cuts to interest rates. And, of course, lower interest rates mean higher house prices. And there's really no great, rocket science background to housing market analytics. It is really about the cost of money. And that's why we did see housing markets generally start to dissipate, particularly the high energy markets through 2017. It's because we didn't have that lower interest rate energy to drive markets that we've had over the previous 5 years. And I think in a way you mentioned forecasting. I think forecasting is going to be a lot easier in the future, because I think we've really validated also in 2017 that we've entered into this new economic paradigm of low interest rates, low growth, particularly low inflation, and of course low incomes growth. And it has been a conundrum for policymakers right around the globe. And I think that once we've got right through that mining boom of previous years, which of course initiated higher rates for Australia when other countries were suffering from the GFC, once we've got through that process, we've started to join the rest of the world, or we have joined the rest of the world in this stagnant economic environment. And that, as I said, means lower interest rates into the future, and that will mean a much more, predictable level of prices growth for most capital city markets going forward.
I guess what that means is the way a lot of people made investment decisions in the past, and the way a lot of people strategise things, is not going to work as well in the future. We are in a new normal. I agree with you, Andrew, and that's one of the reasons I'm looking forward to having this much longer presentation with you at our annual National Property Market Updates around Australia. Did the market deliver any surprises to you in 2017, Andrew?
Well, look, I don't want to sound like I know it all, or no, it didn't, or perhaps a touch of arrogance, but not really. I think that we were always due to see that dissipation of activity. I thought there was still a case perhaps for lower interest rates from the Reserve Bank through 2017. We really started the year with a lot of concerns over the jobs market. We were starting to see a real shakeout in full-time jobs growth. I still thought that required some stimulus. Of course, our interest rates remained and still are higher than most other advanced economies, and again, that reflects the strength of our economy through the GFC period, through the Chinese mining boom. But I think the one surprise, getting back to your original question, Michael, was perhaps that we saw the Melbourne market flatten a little more than I would have expected towards the end of the year. There was some stimulus moving into the Melbourne market with with the reduction or the cutting of stamp duty for first home buyers. We didn't quite see the level of first home buyer activity released as a result of that cut to stamp duty. Yeah, look, the Melbourne market also started to run out of puff by the end of the year, and perhaps that was a bit of a surprise to me that we didn't see stronger prices growth through to the end of the year in the Melbourne market.
Talking about interest rates, I think APRA has now done its job. It's done well in slowing down investor ability to get finance, and so APRA is probably going to now not loosen things yet. It's a bit too early, but probably not tighten things. And I agree with you, Reserve Bank would have liked to stimulate our economy better. We're really a bit sluggish. Wages growth is slow, but it's a bit scared to stimulate the property markets. So we know, though, that, you've said it in your own words, property investment or the property markets is really a game of finance with some real estate thrown in the middle. So what will happen in 2018, in my opinion, will have a lot to do with if the Reserve Bank does something, and we've sort of agreed it may not this year, and APRA does something, and we probably won't affect it either. What other influences, what other trends do you see likely to affect our markets in 2018?
Other than the cost of money and interest rates, when we take that key factor off the table, Michael, we have other, I guess, demographic issues that drive housing markets. And what we did see, part of the catalyst for strong housing market activity in 2017 was strong population growth. And the other end of the equation, of course, is supply. And that's what we did see in 2017 was a continuing downturn in new supply. We've certainly passed the peak of the apartment supply cycle, which has reached record levels in most capital city markets. Of course, we still have supply coming into the market now.
I guess the supply is also not always in the right spot. So a lot of it is in the inner city areas, and that's not where everyone wants to be. You're right that at the moment, 55% of our population growth is due to immigration, and they're coming because of the jobs. So that's the other big factor I see influencing our markets at a state-based level and a micro level, the local economic growth, local jobs growth, which is going to bring people in, which is going to create wages growth. And the last census showed the big differential between some municipalities and others in how some areas the people's disposable income increased considerably more than others. They're the ones who've got the money in their pockets to spend on new cars, new houses, and doing up their houses. So that's good for our property markets. I can see a different stage of the cycle. You've got your own Wilson curve, and I've always been impressed with some of your modelling, which is very different to other people. And you can actually get details of that at myhousingmarket.com.au, your website, where you've got lots of great data. And I know it's only just starting up, Andrew, so I think if people keep coming back to myhousingmarket.com.au, they're going to find, you shared with me in our private conversation some of the great new different data modelling that people are going to be able to get. So I'm really looking forward to seeing that. But how do you see this cycle playing out? Are we going to have the big booms and busts we had before, or is it going to be different?
Well, it will be different, Michael. There's just no case for higher interest rates in our macro economy at the moment. Still a perplexing environment where wages are growing at record low levels, inflation is at record low levels, and this is the challenge, not just for economic policy makers, but for the whole eco-political system generally, is that we're creating this environment where people are working but not getting ahead. In terms of Australia, I think that the Reserve Bank would be very loath to increase interest rates until they see incomes growth start to rise and inflation start to rise. At the moment, no real sign. Of course, the theory is that if you have full employment, employers are competing for workers, and to compete, they need to put up wages. That creates the need with higher wages to put up prices, and then we move into that wages prices spiral outcome, which typically needs higher interest rates to cool that type of an environment. But I think the outlook is for a much more subdued, a much more sublime, I guess, property cycle going forward. To get those roller coaster rides we've had over the last 2-3 decades for house price growth, we really would need to see a concerted period of prosperity, old-time jobs growth, wages growth, and then prices growth to get us back into that environment. I just don't see it occurring.
So different times ahead, and I guess that's the reason why I'm suggesting that people who are watching this should come along to my annual property market and economic market updates around Australia in 4 capital cities, and you're joining me, Andrew, and I'm looking forward to that because the rules are different and you can't do what you did last year or the year before and expect the same results because the market is different. It is a new reality. So people can find out a lot about your new data models at myhousingmarket.com.au. Can you give us just a little hint of what's going to be there as you build that site?
Well, of course, housing market signals are important in terms of decision making. Traditionally, we've looked at house prices as a sign, but the traditional models of house prices have been backward looking. Of course, official house price data isn't collated until well after the event. We've seen overseas using models that certainly include listings data. Listings data tends to be more real time. It does reflect the sentiment in the market. And my models certainly take account of aggregated listings data and a much more real-time feel for what's happening in the housing market. So my housing market, through the Wilson Index, intends to provide investors, owner-occupiers, and those who are just generally interested in housing values with a more insightful measure of housing market activity. We also have other measures such as auction market measures, and the auction market, of course, has been and is a good leading indicator of how housing markets are travelling on a week-to-week basis. But also, all the key economic and demographic data that we discussed before, Michael, that can give us a feel for those underlying drivers of housing market activity.
I think what you've missed out on is your perspective, and that's something that's very important because I know your academic background and people wonder where your doctorate has come from, but you're actually a property economist. That's very different to a researcher. Anyone can get on the internet and think they're doing some research, but you've got the academic background, number one, but also, like me, the years of experience, and you've been through the ups and downs, and I know your history from even having been selling real estate in the years ago in the building industry. I think that's something that you're bringing to the party that very few people can. So I really look forward to spending more time over this year talking with you, seeing myhousingmarket.com.au evolve and speaking to you on a regular basis about what's happening in our markets. Thank you so much, Dr. Andrew Wilson, for your time.
My pleasure, Michael. Thank you for asking.